In my last video, I talked about some of the challenges that active managers face in outperforming the market. It boils down to their relatively high fees and intense competition from other managers. There's another less obvious reason that active managers have so much trouble beating the market. We know empirically that a small number of stocks in an index tend to drive the performance of that index. So trying to select stocks in an index dramatically increases the probability of underperforming that index. When trying to pick stocks in an index in an effort to beat the index, the likelihood of underperforming is much greater than the likelihood of outperforming. This research was published in a 2017 paper by Heaton, Poulsen, and Witt titled Why Indexing Works, and it is yet another blow to active management. I'm Ben Felix of PWL Capital, and this is Common Sense Investing. If we look at data on market returns, the basis of this research is clear. Most of the market's returns come from a small number of stocks. Let's look at an example using data from the global stock markets between 1994 and 2016. Over that time period, global stocks returned an average of 7.3% per year. Not bad. If we remove the top 10% of stocks in that global market portfolio, the average annual return drops to 2.9%. Exclude the top 25%, and the average annual return drops to a much less exciting negative 5.2%. Of course, it would be great if an active manager could identify those top-performing stocks ahead of time, but we've seen the data around their ability to do so. It doesn't look very good. We know that in most cases, active managers' performance can be attributed to luck rather than skill. A lucky manager has been fortunate to randomly select stocks that have done well. In their paper, Heaton, Poulsen, and Witt lay out a very simple example explaining the challenge that the active managers face based on what we know about market returns. If we have an index consisting of 5 stocks and assume that 4 of them will return 10% and 1 will return 50% over a given time period, and we then suppose that active managers are going to create portfolios using either 1 or 2 of those stocks in equal weights, there will be a set of 15 possible actively managed portfolios from stocks in that index. 10 of the 15 portfolios will earn a 10% return due to omitting the 50% returning stock, and 5 of the 15 portfolios will earn either a 30% or a 50% return due to holding the 50% stock, depending on whether it is a 1 or 2 stock portfolio. In this example, the average return of the stocks in the index and of all active fund managers is 18% before fees. Just like we would expect, all active managers together get the return of the market. But when we look at each portfolio individually, 2/3 of the actively managed portfolios will underperform the index due to their not holding the 50% returning stock, which is always included in the index. Closet indexing is the result of active managers owning the market like an index fund, but charging active management level fees, a strategy that is guaranteed to lose. To differentiate themselves from closet indexers, some active managers will pitch themselves as having high conviction or high active share, meaning that they are very different from the index. The research that we have discussed in this video shows that even if you're able to find an active manager that is truly active and has low fees, there's a relatively low probability that they will be able to deliver market-beating performance. With this high probability of underperformance, finding a skilled manager, which we already know to be beyond challenging, becomes increasingly important. Fees typically take the blame for the systemic underperformance of active managers, but this research demonstrates another big hurdle that needs to be overcome to beat the market. If active managers miss out on the relatively small proportion of top-performing stocks, they're at a significant risk of trailing the market. In my next video, I'll be talking about downside protection, one of the most prolific sales pitches in the investment management industry. Do index funds protect your downside? Join me to find out. My name is Ben Felix of PWL Capital, and this is Common Sense Investing. I'll be talking about this and many other common sense investing topics in this series, so subscribe, click on the bell for updates. I'd also love to hear from you as to what topics you'd like me to cover.